combination of Fed policy error and individual bank risk management failures. So I see a lot of people blaming, either the banks or blaming the Fed exclusively, whereas like most things, it's a mix. And so basically, it's kind of a toxic policy combination and just individual bank mismanagement. I don't not in the same way in 2008. In some ways, it has parallels to the 2019 repo rate spike. Which not everybody's familiar with, but it's more severe than that, but not as severe as 2008, at least in the United States. And the reason I would describe it like that is 2008 was really a credit problem, which means that banks made very aggressive and ultimately bad bets. They lent money to entities that defaulted. Whereas here, we're not really seeing that. It's not like they got overly aggressive and made bad loans that are defaulting. Instead, what they did was they ironically bought very, very safe assets, but they bought them at high prices, meaning low yields. And as yields have gone up at like a multi-decade high rate, a year-over-year rate, a lot of those securities are now underwater in price. And it's actually fine if they're able to hold on long enough, because those securities will pay back all their money, or at least, the vast majority of them. The problem is that if they can't hold on long enough, if their deposits get pulled out and they have to sell their assets for a loss, that's when they basically make those losses real. Kind of a secondary and longer term problem is that if deposits flow out of smaller banks and towards the larger banks or the money market funds, then those smaller banks have to raise deposit rates in order to entice capital to stay there. And then the risk there is that they hurt their profitability because they're holding these low yielding assets, probably till maturity, at the same time as they're paying out higher deposit rates. So I would say this is essentially a shock to the system when you raise rates this rapidly. And then it kind of finds out which banks manage that exposure better than others. Sure, yeah, basically to zoom out, there is like that 40% increase in the broad money supply in a very short period of time. And most of that broad money supply is bank deposits. So banks, even though those are customer funds, those are liabilities for the bank, and they're holding them for the customer. So they basically had an influx of deposits, and they had to invest them in something. And a lot of them put them into relatively safe securities, things like treasuries or mortgage-backed securities, which are among the safest assets that a bank can hold. The problem is that those have duration, right? So they might be like 5-year, 10-year, or longer duration assets. And you had this record increase in the broad money supply, super low rates, and then it led to inflation, among other factors. And so the Federal Reserve freaked out and completely, 180-degree reversed their monetary policy. So they started sucking money out of the system, and they started hiking rates at the fastest rate since the 1970s. And so all these banks that bought these longer duration safe assets suddenly found their positions underwater. Now, there's two big risk factors that go into why this particular bank had such a big problem. One was that their deposits were not very high quality because they were concentrated in one industry, tech startups, and because they're mostly business bank accounts, most of them were well above the FDIC limit, and so they had, they're at risk of loss if there should be a bank failure. And so they're basically deposits that are very, very quick to want to move at any sign of a problem, which is not the case when you have a very diversified and smaller, kind of a large number of small accounts. So one is their deposit base was at risk. And the number two is they did not manage their duration well. A bank like JP Morgan, for example, got more into shorter duration types of assets, so they had less losses when interest rates increased so much. Whereas this particular bank, basically made a pretty big bet on long duration assets, which is not like the riskiest thing you could have done, but it is risky because those are relatively safe assets, but they have pricing risk. And so that bank had a particularly large amount of losses relative to its capital, and had a very flighty deposit base. And a number of other banks that either were taken down or were kind of on the verge of going down had somewhat similar risk profiles, both in terms of the deposit side and the unrealized losses side. Whereas banks that have held up better are ones with either a more diverse and larger deposit base, and that have less losses because they in general because they bought shorter duration securities, or a lot of their assets are their own loans on their book and therefore aren't really marked to market in the same way.